Hi everyone and welcome to Inderes TV. Today we're going to talk about Harvia with Analyst Rauli Juva. Welcome.
Thank you.
Approximately 1 year ago we did quite an extensive video about the case, but we have a newly published report, an extensive one, research report, and let's dig into that a bit deeper. So what has changed in 1 year?
Yeah, well, obviously with the company's fundamentals, not that much. So
yeah.
it's still
the same.
It's still very much the same.
Yeah.
Great company in the sauna and spa sector, mostly doing the heaters, of course, but also the full saunas. So the kind of overall picture is the same. The structure is very much the same. What has changed a bit actually in the sales split is that while the European market has declined as we expected, of course, and saw already 1 year ago, the US market and their US sales has been growing. So US is now or North America, mostly US, is now the biggest market area for them that has passed Finland and Germany, which have been the larger ones.
And that happened when?
Throughout basically just now. I think now in H1 that was the biggest market.
Okay, so interesting.
Yeah,
but if you summarize the case, I mean, there was a total boost during COVID, and then we have the Russian exit and a lot of other problems as well in the macroeconomical picture. And we actually are looking at 6 quarters in a row with a downwards trend, but you're seeing some upside potential here. Could you?
Indeed. That of course there was a huge demand boom during the COVID, which as we saw already last year, that started to come down then in the second quarter of last year, and then they exited Russia fully during last year as well, which impacted numbers a bit as well. And then
small question: did they manage to actually get some money out of the Russian exit as well, or is just they just left?
Not really, because they were mostly with the Harvia brand. They were exporting, so they didn't have any own production assets there. So with the Harvia brand, they just stopped kind of exporting products there, and with the EOS brand, the German kind of more premium and professional brand, the local Russian company was actually sold to the I think the managing director or whatever there. So they got like a few €100,000 or something, but that wasn't worth that much anyway. So basically there was no assets as such to sell.
Okay, well, that's a good clarification.
And exactly, it has been declining, and now in Q2 it actually kind of continued to decline, even if the comparison numbers were already kind of from the weaker period from Q2 22. But of course we all know that the consumer demand has continued to decline, and especially the German market has been extremely weak for Harvia, and I guess for other consumer companies as well, which was very strong then in the COVID. So that has continued to come down even after the quite big decline last year. And like you said, we are expecting the Q3 still to be declining in sales, and also just slightly on the earnings as well. But then from Q onwards, and especially next year, we believe that the kind of markets are turning up again, and Harvia will continue to grow and grow their sales and earnings.
So if we kind of estimate that it will turn around the next year, but where will the growth come from? Is it more on the American side, or because thinking about Germany, an important market, but what about the energy crisis and the German consumer and going forward? I mean, where would the growth come from in the future? Yeah,
definitely the main areas of growth are the ones which have been growing also actually now during 22 and the first part of 23. So US and the other countries segment, which is basically the rest of the world excluding Europe and US. Japan is a big market for Harvia in that segment, where they are now putting more effort. So those are definitely the main growth engines. So kind of newer sauna markets around the world, and then the US, but they do also have a potential in Europe in some of the markets, and also kind of expanding the product portfolio, so that there could be growth opportunities there. And Germany specifically, we do expect also some recovery actually already next year. Whether that happens already next year and then later, of course, it's a bit of a timing issue, but the market is definitely now kind of at an unusually low point, if I have understood it right from the company. There is no public data on that.
But if we always come back to the fact that we still think that this is a quality company. If we could dig deeper into that, what does this kind of quality stand for, and what does it mean? In terms of what?
In quality, quality. I think to me, quality at least means that there is clear competitive advantages, and for Harvia, we have opened up that in the report, kind of in a separate page. So
we will put the link down below.
So for Harvia, it basically means that they have quite strong vertical integration. They have very efficient production, so they are actually doing most of the components and also kind of some tools themselves, and they are getting a bigger part of the kind of the value chain and being able to manage that quite efficiently, and through that actually have a very attractive pricing also for the consumers, and being able to also be quite profitable in the low price segments. So that's one, and then the second is of course the strong brand or brands. The Harvia brand, of course, the main brand, and also this, I mentioned this EOS premium professional brand. So I think those are the main two. Harvia is very known in the sauna markets, I think.
And have I understood this correctly? It's a strong brand both from a consumer perspective as well as professionals.
Exactly. At least in the kind of more traditional and sauna markets, like in the Nordics, Harvia is well known for the consumers, and then maybe elsewhere the sauna market actually is more of the saunas are more in like spas and hotels and so on, so the consumer might not know it, but it's the installers who know that this is a good brand, and I could put it there and it lasts, and it's a good heater and so on. And then definitely one aspect of the quality is the stability and level of margins and returns on capital. So that's actually kind of one point. Comparing to last year, we expected that the margins would decline.
Let's talk margins.
Decline quite a bit. They were doing as high as 25. In the COVID years, and their target is to be over 20 at EBIT margin, and we were expecting last year that they would actually go a few percentages below, which would still be a good level, but now they have actually managed to stay above that 20% target, even if the sales and especially the volumes have been basically crashing down. You could say so. That has been definitely a quite strong testament to their ability to adjust and be efficient in the production. And I think that's
a secret there.
That's a very strong achievement for a company who is there producing most of the stuff themselves, and being able to handle the margins in such a big volume drop is a very good achievement.
Excellent
and that good margin and the still quite low, or actually very low capital needs, considering that they produce most of the products themselves. That combination gives also very good returns on capital. So they should be returning now in the coming years when the earnings bounce back somewhat. They should be returning to around 20% returns on capital as well. And now they invested in the COVID years in the production quite a lot, which is only a few million in their terms is a lot in investments. And now they can actually grow with the current capacity quite a few years quite nicely without putting much money in the production.
So let's talk a balance sheet a bit more here. And cash flow, some comments on that. Investments made, not that big, but how do you see growth in that department going forward?
The balance sheet is strong. They had a bit of the problem, which was quite common in the consumer companies, especially a year ago, that during the COVID years they kind of everybody tried to get all the stuff they can with the supply chain issues, and then the demand dropped, and the kind of stuff was left in the inventories and whatnot. But then they have been able to reduce the inventories, and as they have been delivering quite good profits, there's of course quite healthy operational cash flow, and without any or very, very small investment level, that's actually rolling quite nicely to converting to cash in their balance sheet. And that has resulted into the fact that now they are actually below their target. They have a leverage target of being between 1.5 and 2.5, and now they were in end Q2 a bit below. That was it 1.2 or 3 or something like that. And that should come organically actually quite rapidly down when the cash flow flows in, and
that's kind of stability in the cash flow.
And that will be most likely used to acquisitions then at some point, which we believe is a good thing, because their track record from the acquisitions is very strong. So we believe that capital allocation to the acquisitions will be actually beneficial for the shareholders as well. Of course, another alternative is to hike the dividend payout, which could be also a possibility gradually to do, but I wouldn't expect any large one-off dividends, because their aim is clearly also to do acquisitions.
Okay, in what kind of time frame do you have any idea?
The acquisitions, you mean? Well, I guess it depends when they find suitable targets for a good price, but do you see it more likely in the US, or if that's a growing market, or even in Japan or something? It could be not maybe so much in terms of entering new markets. There's probably not that much to buy if there's a kind of new sauna market. But US, why not? And maybe especially getting new product segments. Harvia is very strong in the traditional sauna in the electric and wood heaters, but they are very small in the infrared and steam side. So if they could acquire that competence, that would be quite interesting then also in a cross-selling perspective. But from time horizon, now is actually, I would say, we probably said, or at least wrote a year ago, that it's a difficult time, since the earnings are coming down, and maybe the sellers are not willing to sell with the declining earnings and so on. Now it's of course kind of everybody knows that the earnings have come down and perhaps stabilizing and turning a bit more up next year. So and the interest rate have kind of risen to the level they maybe are for now. So in that sense, it's definitely, I would see it much more likely that there would be something happening in, let's say, 1 to 2 years than I thought a year ago. But of course, it's always a question that when they find suitable targets, they are not in a hurry to do anything. They have done, I think, the acquisitions like 2016, I think. 16, 19, 21, 16, 18, 19, and 21. So like roughly one in 18 months in history. So I guess if that's any guide, you could expect something in the next 2 years. One
thing about we talked about the margins and the production. Isn't that, and they're producing everything themselves, but couldn't there be kind of a risk there as well? Because it's quite, do I remember correctly? I mean, Muurame is really a hotspot here. Or am I thinking this wrong?
There is some risk. The Muurame, the small town in the middle of Finland, is the heart of Harvia, definitely still, and the heart of the Harvia steam production. So of course, if there would be something drastic happening for that facility, that would definitely be a problem in the short term for their production.
Because you have learned from other cases, I mean, Nokian Renkaat and stuff, we're not putting everything in one basket, or I mean, too big risk.
For Harvia's benefit, it's like I said, it's quite kind of asset light production, so you don't have a lot of expensive machines. It's more that you have some machines and raw materials coming in, and people kind of shaping that in the right way, and
components,
and putting stuff together. So it's definitely much more easier to also build up in a new location or move than, for example,
some kind of lightweight production.
Yeah, it's much more easier than a tire factory or any.
Have you been there? Okay.
Okay.
But I'll take your word for it.
Yeah, but still, of course, if the whole facility would burn, of course, you would have a big problem for a while.
Anything could happen these days.
But they have, luckily, they do have now a bit of a kind of network also. They have some production in China and Romania and the EOS production in Germany. So not everything would halt if something would happen there, but it would still be a problem. Yeah.
Okay. Yeah. But still, something to think about. Yeah. Let's go into valuation and recommendations. So say something about the valuation at the moment.
That's I think for this kind of company, it would be nice to give you a kind of clear statement that it should be valued with this multiple. But it's always a question of what's the kind of what year are you looking at, when how much the earnings are going up or down after that, and then what's the cash flows and so on. So, but if we look at purely the multiples, it's in rough terms now for this year. It's PE 20 and EV 15.
Yeah,
that's not cheap, definitely.
No, it's not cheap. I mean, 6 quarters in a row in a downwards trend, and I mean still a lot of risks and insecurities.
Well, actually, I would say it so that now there are not so many risks anymore. You know, a year ago it was clearly the case that you should still kind of keep in mind in the multiples that you have quite a lot of uncertainty that where actually will be the trough of the demand after COVID. Now we are closing to that. We are not exactly there.
1 year ago we said quality on sale. What would you say now?
Exactly. And luckily we were right on that call. But now it's not on sale. Now it's, I would say, quality at a quite fair price to sum it up. But you know, the multiples for this year, like I said, you should keep in mind that you know, it's the lowest point now, and we are expecting it to turn up again. Of course, if you disagree with that, that's a different case. But we believe that will happen. And then one important thing is the cash flow, which I've emphasized already. Since they are not doing a lot of investments, they are creating very good cash flow. So thinking in cash flow terms, the current earnings is delivering something like 7% free cash flow yield. And then if we kind of assume that is growing 5% for the coming years, even for a longer term, 3 to 5%, that already alone, that combination gives you a kind of a double-digit return expectations, which is quite fair.
Dividend.
And dividend is only part of that. So dividend is 3%, and which kind of that difference, of course, means that the rest is going to a stronger balance sheet and maybe later on to acquisitions, or then they will need to hike the dividend yield closer to the free cash flow yield. But that's the picture. And then also this good cash flow does show up in the EV multiples, which go quite nicely down. Then if it was 15 for this year, next year when the earnings are going up, the debt is going down. It's already like 12 point something. So it's showing up there, and that's definitely not expensive anymore. It's more on the cheap side for this kind of a quality company with still a nice longer term growth potential and solid high margins and returns on capital. So overall looking pretty good, but definitely not such a clear valuation case as it was 1 year ago.
What about the recommendation at the moment?
Well, that's we are maintaining the accumulate side there, reflecting this what we talk about, that the valuation is pretty okay for this year, but we see a quite nice cash flow returns and increasing profits going forward, which should support then the share price as well.
Yeah. Perfectly summarized, I would say. And if you want to know more about the case, please read the extended research report, and if you have questions, you can ask them and you will answer.
Yeah, sure.
See you. Bye.